What's going on, everybody? Listen, last week I told you the doors to private markets are finally swinging open for the everyday people. Well, here's the door that's swinging open the fastest. It's a multi-trillion-dollar industry most folks have never heard of. It's called private credit. Right now, it's the single hottest trade on all of Wall Street. So here's the stake. If you've ever been turned down by a bank for a business loan, if you've watched the branch in your neighborhood close its doors, this is the story of who started lending when banks walked away, and whether that's a lifeline for our community or the next bubble waiting to pop. Guess we're gonna see. Welcome to Money Market Briefs, where we discuss all things private equity and private capital. I am your host, Tariq Collins, and this show is brought to you on behalf of the Capital Alliance Network. Listen, don't forget to like, share, and subscribe so we can bring you the best content, bring guests on the Money Market Briefs to give you the updates on what's happening in the private markets around the world. Right? We love engaging with you, and we welcome the feedback for sure. We're trying to get better, so let us know what you think. Listen, why does this matter to you? Because the banks pull back from exactly the kind of lending that our businesses depend on, the small loans, the local deal, the borrower who just doesn't fit a rigid computer model. And when the bank stepped back, somebody else stepped in. Understanding who's doing the lending is understanding who controls access to capital in our communities. And that's everything. Period. So here's the question. How does an entire $1 trillion lending industry grow up almost overnight? Outside of the banks, most of the public view, and most of us never even noticed what's happening. Well, here's the answer. Private credit is a non-bank, privately negotiated lending. The fund is your lender, partner, and negotiator, not a bank that chops your loan into pieces and sell it off. The main strategies for private credit is direct lending to mid-market companies, distressed or opportunistic, asset-backed, and a specialty consumer finance. So these guys are direct lending from their fund to you, your business, that needs the lending. So you don't go through traditional banks. Where banks have constraints, the private credit don't in more ways than not, right? It grew out of leveraged lending in the early 80s and 90s, then exploded after the 2008 financial crisis. So this private credit thing has been around for a long time, and some companies has been doing it. Asset managers, hedge funds and private capital or private equity firms have been in the private credit space. It just wasn't formally used as private credit. They were in credit. But it blew up really after the 2008 financial crisis when we had a run on the mortgages, right? So today, roughly $1.5 to $2 trillion in assets. Some banks project it could hit $5 trillion in the next several years. So this is a big industry that's been going on for a long time. Now, you assume that private credit blew up because it's some clever new Wall Street invention, and here's the truth. It's the opposite of new, right? I just told you they've been around for a long time. But lending used to be all private, one person, one handshake, one deal. That actually happened is after 2008, regulators forced banks out of riskier middle market lending. And that left a huge hole in the industry. And private credit is just Wall Street rediscovering the oldest form of lending there is and getting paid for a fortune to do the job banks abandoned. So when they restructured how banks give out loans, it put tighter restrictions on banks, right? And if you're already in minority or low growth areas, right, there's even more constraint in that. And private credit stepped in where banks could not to be able to provide companies with alternative funding or intermediary funding in between them growing or getting to banks or growing and getting to institutions that's raising capital for the company to grow. And private credit comes in and do the lending just for that. They do it based off what assets you have, right? So it's a whole lending structure, credit worthy. It's like banks. It's just a little less constraint because you're dealing with the fund manager or credit manager over that specific fund to lend to your business for whatever your specific needs are, from a public company to grow and expand, or a private company that's looking for a little funding in between funding, or some growth funding to get them to the next stage for their business. And obviously, the payments to the loans is a return on capital for the fund that's doing the private credit. Does that make sense? The second Wall Street realized that there's a fortune in doing the job banks walked away from, the biggest name you already know came rushing in, right? These are all the big funds are doing this. The same firms that's running private credit or private equity is now your lender. And so we just want to follow the money. So all your big fund, Blackstones, Apollo, KKR, BlackRock, the asset managers, all these guys and girls are jumping in on the private credit side because there's opportunity to fund these businesses and get a return on investment. We're talking direct walk up to one of the firms and say, "Hey, we are trying to lend, or we need a loan because we're trying to acquire this company, or we're trying to execute a roll-up strategy with these three companies in mind, or we're trying to grow our firm and we need money to be able to do direct investments toward these 2 or 3 areas for our business to grow. Here's what our revenue looks like. Here's what our expenses look like. Here's what our net profit is, or EBITDA, if you will, how much money we have afterwards. So we have the margin room to be able to not only grow with the investment dollars that you give, but also pay back the loan with the interest and et cetera that you're looking to get, which gives the return on investment to that private credit fund, to the investors and the LPs that invested in that fund, to be able to have a return on investment for the money that they made. And it serves the opportunity where there's a gap between bank lending and getting to the everyday business owner that's looking to grow and not looking to be held up by any constraints and get after what they're looking to do, right? So when a handful of firms control who gets lent to, they control who gets to grow, basically, right? Because lending is the access to growth and capital, which is the access for you to grow your business, which is the access for you to scale your business, which brings in more opportunity, more investments, more people. You see where I'm going here. It just keeps tumbling down. And if this thing is a bubble, understand who gets hurt first when it pops is the thing that you have to consider. Is it a bubble? Is it really a bubble, right? It's not the Wall Street firms with the diversified book. It's the borrower at the edge. It's the one with the least cushion. So whether this is a solid ground or quicksand matters most to the people who can least afford to be standing on it, which means that the private equity fund or private credit fund itself is diversified. They're investing in not just you, but this person, that person, the person you know, the next person. They diversified their risk over several different investment ventures that are out there. So the risk is not necessarily on the fund failing itself. It's really on the person that's taking in those dollars, consuming those dollars, and having to do a return on investment by way of them paying back the loan, etc., to these private credit people. So if you're getting the money and you're strapped, right, you have to really be able to provide value inside your company from an operations standpoint to be able to serve a high quality product or service to high quality customers and clients, for them to go out there and change their lives or impact their lives and impact their community and provide a return back to the money that you borrowed. And that's where the risk lies, right? So here's the fight. Everybody on the finance Twitter is screaming that the private credit is the next bubble, right? If you look at the market, the private credit is the next bubble, the next bubble, the next bubble, private credit, private credit, private. The media will have you thinking this is about to pop. Right? Institutions say, relax, it's fine. So who's right? And more importantly, how would you even tell the difference between them before it's too late? So here's the players. The same names from the PE, Blackstone, KKR, Ares, Apollo, plus Churchill, Benefit Streets, Monroe. Blackstone market is back credit fund to affluent investors. The concentration, just in Q1 2026 alone, the snapshot showed that the 5 largest private credit funds grabbing about 60% of all capital raised. Churchill did 16 billion senior loan strategy. Goldman Sachs asset manager about 13 billion mezzanine fund. Ares a multi-billion dollar credit secondaries fund. Is there really a bubble? This is all Q1 2026 for private credit alone, right? They have the fastest growth, the leverage, amend and extend deals, the covenant like terms, the valuations, the losses can get pushed into the future. Like these guys are winning and they're going after it. On the other side, JP Morgan and others are saying that private credit is still under 10% of total corporate borrowing. So we got a 16 billion from Churchill, Goldman Sachs 13 billion, multi-billion from Ares, not a specific number, but 60% of all capital raised toward private credit. But from a noteworthy standpoint, 10% of the total is private credit is still 10% of the total corporate borrowing, which means it's not huge leverage on this side, right? So the leverage and realized losses look manageable because of its senior secured lending with direct borrower engagement. Right. So at iCapital, Sonali Basic points out that defaults and losses, not headlines, are what matters. So far as private credit quality is held up, the headlines, guys, we got to ignore. What's actually happening here? And we just did the numbers. 60% of all capital raised for private credit, right? But when we look at the total market share, and this is probably based off the large of the public markets for sure, because that's where you get the most access to information, it's still 10% or it's under 10% of the total corporate borrowing. So is it really a bubble? Or is it managing really how it's supposed to, right? As long as the quality is held up, how do you ensure the quality of there is held up? By investing in the right companies. The same way you're going to pick out for your private equity deals, your venture capital deals, and your other deals, you want to secure and make sure that whoever you back is going to be back good. That's one. Insofar as that they can return the capital, grow their company for what they intended to borrow this dollar from, and that they're not over leveraged in doing so. Right? So now here's where almost everyone gets it wrong. You hear a bubble and you picture 2008. Oh my God, the stock market's going to crash. Everything's going to crash. I'm going to lose my house. I'm going to lose my shirt. Well, the sudden explosion, mortgage blowing up overnight, but that's not the real risk here. The real danger isn't a bang. It's the slow burn, right? It's those loans, the deals that let struggling borrowers look perfectly healthy on paper for years. So the threat isn't the size of the market, it's the fog. You can't see the stress until it's already deep, right? It's the headline number. That's the thing that's going on here, right? And that fog matters most for the people who can least afford a surprise. So if you're borrowing and you're already risk and you can't afford like you have no room for failure here. That's where the risk is, which is why on that credit side, these firms are leaning in heavily on evaluating deal by deal by deal. Who's the best people to fund the deal to? Can they return capital? What do their assets look like? Can I like you? Can I trust you to return capital? Assuming that all things is good, everything in business is a risk, especially when you're trying to borrow money for the growth. It's all risky. But what can we do to mitigate the risk? How can we ensure from the investments that we make that we mitigate this risk and get a return on investment, right? And that's what you want to do. So what you want to watch out for. The biggest stake of this thing is for generations, bank underlent in the black neighborhoods and to black-owned businesses, credit deserts, the long shadow of redlining, rigid underwriting that said no before it said hello. Now, there's a brand new source of capital that doesn't run on the bank's rule book, right? Think about that. For years, black people have been marginalized, redlined, not even accepted. Walking in the door, you already got denied for the loan, right? So this is either the biggest funding opening for black entrepreneurs in a generation or is a brand new way to get taken advantage of. And right now, technically, both are on the table. Because of the private credit opportunity, we don't know what's going to happen, right? Do we just assume that lending is going to happen like how it always or traditionally happened? I wouldn't assume that. The opportunity is there. The private credit gives an opportunity for you to get funded in non-traditional ways, which is how most wealth gets started. Your susus, your families, other cultures coming in, invest in a pool of money that goes here. You reinvest that money to give it back to the community for the community to reinvest into another venture or another business. That's how this thing works, right? So the bank spent decades saying no to our businesses, and now there's trillions in flexible capital out there looking for borrower. Is this our opening or is it a trap? Is it our opening or is it a trap? I think it's our opening. It's a way for us to get in. But what do you think? Now, specialty finance and asset-backed private credit can step into the gaps where tailored small balance consumers and small business loans, exactly where many Black entrepreneurs operate. So these are the intermediaries between you getting funding and you not. If banks aren't giving it to you, we have to look for alternative sources for capital, and private credit offers that. It's increasingly accessed through fintech tech platforms, which lower the frictions for borrowers and the big banks overlook. The nuance, the same flexibility that can replicate predators' patterns, high cost consumers or payday style lending, if it's not structured and regulated well. Now, your instinct is probably more access to capital is automatically a win for our community. Access without knowing the terms is exactly how communities get extracted from instead of built up. Now, this is a great opportunity, in my opinion, for anybody to get lending that they can't get it through outside source, more especially if you're Black or minority, right? However, you need to understand the stakes and the terms of these lending so that we're able to do a return on capital and we're able to get relent. Every person affects the next person, believe it or not, right? The very thing that makes the private credit a lifeline, no rigid banking rules, is the same thing that lets bad actors in, right? And can destroy the process. So if we're going to go after this private credit, we just got to make sure that we're doing the right thing. We got the right thing. We got the right product or service. We get the right thing. We get the right partner to help back us with this private credit lending. And what other resources do they have to help these businesses grow? Not only just lending out debt to us from a private credit standpoint, but what ways can you help me leverage my skills for growth in my company for whatever product or service that I'm offering for us to be successful and for you to be successful? There's a tie-in here, right? Not only are you just giving me money that makes it seem like I'm just a risk and have to return the capital, but now we're both in this investment to pan out because you got to lend back to your LPs. I got to be able to grow my business. We got to pay you back, and there's got to be an exit. So now we created a partnership with this money and not just a banking institution that's knocking on our door like Mr. Scrooge, where's our money that we lent you, right? Does that make sense? So the real win is never just getting the money, it's knowing what to ask for before you even sign it, right? So where are you seeing private credit show up in your own life? Businesses lending, the fintech, lending platforms, the buy now, pay later, small business funding, increasing your 401k and wealth platforms. This happened with the 2025 executive order, opening retirement accounts to private markets. Now you're getting into private credit, right? So the question is to ask a borrower or before you receive money or the investor that you're looking to go after is, what's the real all-in rate, not the headline rate? What's going on here? What's the rate of what's the interest rate? What's all the stuff that we're going to do? Typically, most people are at prime or the Wall Street Journal prime plus 2 or 3%, depending. Is it a senior or a secured? Where do I sit if things go wrong, right? If it's a senior or secure, where do I sit if things go wrong? If something happened, what's the mitigation risk? What happens to me? What happens to the loan? What happens to my business? What do you pull? What do you don't pull? How can you help me if there's a need to be helped? But you want to position yourself like, hey, we're getting lending. Business is doing great. We're taking in outside debt for growth. And the growth is going to do A, B, and C. Here's how the money's going to return, and here's how we're going to return lending or pay back the loan that we got from you. Does that make sense? That's how it works, right? And what happens if you miss payment? You want to know all the details of this so you know exactly where they stand from a lending standpoint and where you stand from a borrower standpoint. But the private credit markets is out here, right? So we just walked through the private credit. I think that private credit is one of the strongest institutions that's out there. More to follow on as we continue to divest this story on Money Market Briefs of what's happening in the world of private markets, private credit, and private equity. Private credit is going to be something that's constantly talked about because it's providing opportunity where lending is falling on constraints. Although you have these SBA preferred lenders and ways for you to get in these independent deals, you have your mid-market businesses that's looking for growth, and they're too big for small banks to back them, and they might be too little for the big banks to go after because it's considered risky. And your private credit is coming in and lending this money on a cash flow basis. They're using your cash flows. They're using the business assets. They're using the business assets to back the loan and your cash flows to pay off their loan while you're using this money to grow and expand your business. And that's the way that we can win. If we're a minority in a marginalized community, we just have to find these ways and avenues to get into these firms for them to invest in us, deploy debt capital our way for us to be able to pay back and be able to do a return on investment and double down and continue to do it again. So, all right, y'all, that's a wrap of today's episode of Money Market Briefs, bringing you your weekly news and updates of the private markets. Don't forget to like, share, and subscribe. Hit that bell to stay notified of when we see you next week, and I'll see you next week, same time, same place. Peace.